Hello, everyone. This is my introduction to this week chapter. I know that you would have already started looking at the chapter, and if not, I do recommend that you start reading through the chapter. It's very important for some of the assessments that you'll be completing later in this course, particularly the projects and some other homework. Now, if you look at this topic, it focuses on variable costing and the measurement of ESG and quality cost. The measurement of ESG and quality cost is a very straightforward aspect in terms of non-financial data, non-financial performance analytics, and the impact of quality cost to business and the impact of environment to business under the ESG, which is called the environmental, social, and governance. This ESG is actually becoming quite popular in managerial accounting, so I do recommend that you read through it. I actually have a research that I am currently working on to get published on ESG. So there are other resources, literature you could find through the your university library to be able to read more about the ESG. Now, the variable costing is the aspect I want to emphasize in this introduction video. Now, assumption costing and variable costing, you might be wondering, what are these two types of costing? There are two types of costing that focuses on estimating the product cost. The key focus on whether you use variable costing or assumption costing depends on the purpose or the organization policy. Now, we're going to look at the absorption costing first, and then we'll look at the variable costing. So typically, when you cost a product, you try to estimate what does it cost to manufacture or to produce that product. That is different from the business total cost. The business total cost comprises of the product cost and the operating cost, which we call the period cost. So the product costs are things like direct material, direct labor, manufacturing overhead. And then the period costs are things like administrative expenses, the CEO salaries, manager salaries, because these are not directly involved in production of the products, except if the manager is also perhaps a factory worker that operates machine directly that converts the raw materials into finished products. So this is why it is important to understand how you estimate the product cost. And again, the regulation in terms of how you estimate the product cost that you include in your financial statement is determined by the accounting regulatory bodies. So, for example, the financial standard board for the US will prescribe a specific way that you should follow in order to estimate what the product value should be that is included in financial statement. And that method that is commonly used, whether you're looking at FAB or you're looking at IFRS, which is accounting standard that is introduced by International Accounting Standard Board, they typically recommend using the absorption costing. What the absorption costing basically does is that it absorbs some of the fixed manufacturing overhead as the product cost, which makes sense. But on the other hand, if you're looking at internal decision making, you're not looking at publishing financial statements, then some businesses will use variable costing. And if you use variable costing or absorption costing, that will affect the profitability of the business. And this is why the ethical practices in accounting becomes very important, because managers could basically use variable costing if it benefits them, if it's going to show that they are doing very well with the profit, why in a conservative way, some manager may choose to use the assumption costing. I'm going to show you how the profit will look like if you use the assumption costing method and then the variable costing method. So product cost, remember, product cost will include both variable cost and period cost. And irrespective of these two types, the product cost typically comprises of the direct material cost, direct labor cost, and the manufacturing overhead cost. In other words, is both direct material and conversion cost. So the variable costing, what it does is that it doesn't include the fixed cost, unlike the assumption costing that absorbs some of the fixed manufacturing cost. In the variable costing, it only includes the variable cost as the product cost, and that has implications. So here's an example of the impact of the assumption costing and variable cost. In other words, this is a comparison. So direct material, direct labor costs, and variable manufacturing overhead costs are absorbed as the product cost, while the fixed manufacturing overhead cost and then the selling, why the selling and administrative expenses is considered as period cost. In other words, the fixed manufacturing overhead cost is basically absorbed into the product cost, but it's not considered as part of the period expenses. On the other hand, if you look at the variable costing, the product cost, what constitutes the product value is only the basically is only the variable cost. Okay, so only the variable cost will constitute only the variable cost will constitute the product cost, while the fixed manufacturing overhead cost and the selling and administrative expenses will be considered as period expenses. So to put this in a short summary, under the assumption costing method, the product cost comprises of the variable cost of the product, which is direct material, direct labor, variable manufacturing overhead, which is the same as what you have, and then part of the fixed manufacturing overhead that is related to that product, while the period cost will be the selling and administrative expenses only. Then for the variable costing, the product cost will comprise the variable expenses such as direct material, direct labor cost, and the variable manufacturing overhead cost, while the fixed manufacturing overhead cost is not part of the product cost. For the variable costing, the period cost will be the fixed manufacturing overhead and the selling and administrative expenses. So the difference between the assumption and the variable costing is the treatment of the fixed manufacturing overhead, which is this one you have here. Okay. So you could say from this line here, all of these items here are part of the assumption costing. Why for variable cost, only these three in the top are part of the product cost. And then the fixed cost is part of the period cost for the variable costing method. So here is a case we could look at to see how using the variable costing and the assumption costing differs the profit of the business. Now, assuming that this business Mailer Code product produces a single product with the following information: number of units produced annually is 25,000. Then here is the variable expenses, which include the direct material, direct labor costs, and variable manufacturing overhead. Total is $10 a unit per unit. And then the selling and administrative expenses is $3 per unit. Now, the fixed cost per year is the manufacturing overhead cost, which constitutes $150,000. And the selling and administrative expenses is $100,000. Now, we can use this information here to prepare the statement, the profit statement for Melo company. But we have to decide what method to use, whether to use assumption costing method or the variable costing method. Now let's use the assumption costing method first, and then we will use the variable costing method. Right here in the assumption costing method, we could say that the product cost will be the $10, while the $6 here will also be part of the product cost, but it's a fixed manufacturing overhead cost. So the total product cost under the assumption costing method is $16. Now for variable cost, if we use the variable costing method, the product cost per unit will be $10, which is the variable manufacturing overhead only, which is direct material and variable manufacturing overhead. The fixed manufacturing overhead is not included, is zero in the case of variable manufacturing overhead. So now if we use this information here to prepare statement for using each of these two methods, let's look at the example under the assumption costing method first. So under the absorption costing method, assuming that the product was sold for that 20,000 of the 25,000 units that we produced was sold for this business, and it was sold for $30 per unit. Now the sales values for absorption costing is going to be $600,000, which is 20,000 multiplied by 20,000 units multiplied by $30, the selling price per unit. And now we will less the cost of the goods sold. In the cost of the goods sold, we say the beginning inventory, which is zero in this case. The first thing we have to determine is what is the cost of goods manufactured. So we look at add the cost of good manufactured, which is the product cost, $16, multiplied by the number of units produced. So the total cost of good manufactured is $400,000. And now the cost of good for the cost of goods available for sales is $400,000. Assuming we have beginning inventory worth $20,000, we will have that right here. And then the cost of goods available for sale would have been $120,000. But in this case, it's zero. So we end up with $400,000. Now, out of this $420,000 worth of goods, remember that only 20,000 from the 25,000 units produced is what was sold. So we multiplied that 20,000, perhaps if you like, by the rate of the products. So we will ideally have $400,000. Now we have $5,000, 5,000 units that is that is in the finished goods inventory. Now these 5,000 units has not been sold. It stay in the inventory, and the cost of goods for the cost of goods available for sale was $400,000. Now, to determine the amount of goods, the value of goods that was sold, then we basically minus the ending work in process value from the cost of goods available for sales. That gives us $320,000, which means the 20,000 units that was sold cost the company $320,000. So what happens to the value for the ending work in process for 5,000? This value here will go to your balance sheet under the current assets section of your balance sheet as goods, as your finished goods inventory. Right. Now, we can therefore calculate the gross profit or the gross margin. So in the gross profit, we're going to minus the cost of the products, which is the cost of goods sold, if you like, minus that from the sales revenue. And that will yield gross profit of $280,000. Now, next we will minus the period cost. The period cost is $3 per unit, and then the company sold 20,000 units. So the period cost will be 60,000 plus the fixed period cost, which is 100,000. Okay, the fixed period cost. You have to understand the difference between fixed period cost and fixed manufacturing overhead cost. Okay, so we don't have that here because the fixed manufacturing overhead cost is already built in to the calculation for $16. If you remember that in the previous calculation here, which is this one here. Okay, so this fixed period cost, it makes its administrative expenses. It has nothing to do with the manufacturing or the production of the product. It's more or less like a business cost. Now, if you add this together, it gives you $160,000. Now, you minus this period expenses from the gross profit, that will give you net income of $120,000. This is under the absorption costing method. The profit is $120,000. Now, assuming that the company chooses to use the variable costing method, this is how the profit will look like. Now, the sales revenue is the same. Will it change? The only difference you will see is that the profit will change and that the cost of the products will also change as well. Now, the cost of goods available for sale, or the cost of goods manufactured rather, the 25,000 units multiplied by $10, which is the variable cost per unit under the variable costing method. Okay, in other words, is the product cost, $10. Okay, multiplied by the number of units produced, $25,000 units, that will give you $260,000. Now, the cost of goods available for sale is $250,000 minus the ending work in process. The ending work in process, because the product cost is $10, then is $50,000. So minus that from the cost of good available for sale, that will give you $200,000 as the variable cost of goods sold. That is different from what we calculated earlier. What we calculated in the assumption costing method was $320,000. Now, the next thing we want to do is to consider the variable selling administrative expenses as in order to determine the gross margin or the contribution margin. So when we when we add this amount to the product cost, that will give us $260,000. So this $260,000 is ideally not the the product cost. The product cost will be $200,000, but because we have this variable selling and administrative expenses, that becomes $260,000. This is just an approach that is being used here. Now, the contribution margin, $340,000, which is technically more than what we got here, $280,000. Now, if you look at the period cost is way higher than the assumption cost. Is way lower than the assumption costing method. Under the assumption costing method, the period cost is $160,000. Okay, why the variable cost, it should be higher because the fixed manufacturing overhead is written off as period cost. That should give you about $150,000. So it's way higher than the assumption costing method. Now, $250,000 minus the contribution margin will give you $90,000. So this $90,000 will be the net profit. When you compare this to the assumption costing method, the assumption costing method appears to be more profitable than the variable costing method. So this is the impact of choosing whether the part of using the variable costing method compared to the assumption costing method. Now we can find out where that value is coming from. That value is basically as a result of any work in process and then the period cost. Now, if we go back to the estimation of the product cost per unit, under the assumption costing method was $16, and then under the variable costing method was $10. Now, if we have any work in process of 5,000 units, which we have here, okay, which we have here, 5,000 units. If we multiply by the difference in unit product cost, we will find out that we can basically reconcile this amount to become 120,000 unit profit as well. So we can work that out here. Now, here is the worksheet I'm going to use, $6 difference in the unit product cost, and then 5,000 as the end product cost. And then the value of this end product cost is $6 multiplied by the end work, the finished goods inventory, which is $30,000. Okay. Now, remember, under the variable costing method, the profit was $90,000. Now, when we add $90,000 to that, that is going to give us the same amount as what we have under the variable costing method. So let's add this to, basically you have $120,000. Okay, so that is the same thing as what we have under the assumption costing method. So $120,000. So where the difference comes under these two methods is because the product cost under the assumption costing method absorbed part of the fixed manufacturing overhead cost, while under the variable costing method, the fixed manufacturing overhead cost is written off in total in the period in which the fixed manufacturing overhead cost was incurred. That is what you see. That is what you see here. The total fixed manufacturing overhead cost is written off in the statement of profit and loss in the year that the cost was incurred. While under the assumption costing method, part of the fixed manufacturing overhead cost is absorbed into the product, while part is kept in the ending work in process, and therefore it inflated the profit for this business. Assuming that there was no ending inventory, the profit would have been the same, $120,000 for both methods. I hope this video was useful to you. If you do have some questions on this topic, feel free to send me email on the course material.